confidence, control, knowledge, safety, success, investing, making money, money school. What are stocks and bonds? That's where you'll start and move rapidly into the how-tos of working with a broker, buying stocks and bonds, reading the financial pages, and so much more. Craig Lewis, certified financial planner and longtime money manager, will be your guide through the financial jungle. The goal is for you to gain the knowledge you need to make informed decisions and succeed. And now your guide, Craig Lewis.
How are you doing? We're ready now for an in-depth look at stocks. Let's say you wanted to buy a stock. There's basically two ways a stock is bought and sold. You have the listed stocks, which are on the exchange, and this is what an exchange might look like. This is a rough drawing of the New York Stock Exchange. On the sides are the tables and the offices of the different brokerage firms. So you enter an order to buy 100 shares of the company. Here's how it works. The broker writes up the ticket and enters it into the teletype machine. Normally it goes through the central computer of that brokerage firm and then straight to the floor of the exchange. The floor broker has it come out on his teletype machine and runs the order around to where ABC is traded. Now all of the exchanges are an auction market. That means that someone is willing to buy 100 shares and someone is willing to sell 100 shares. They might be willing to buy at 12 and sell at 12 and a half. So he runs around here and he says, what is the market on ABC? And he asks the specialist in the booth, or he looks at the computer and they say, well, it's 12 to 12 and a half. That means they would buy it at 12 and sell it at 12 and a half. So he wants to buy it. He has to buy it at what someone else is willing to sell for. So I have to buy for what someone else is asking. And what they're asking might be 12 and a half. Now, when you put in your order, you have two ways you could have done it. You could have said, buy it for me at the market. He would then run around and say, what's the market? 12, 12 and a half. The floor broker buys it for you at 12 and a half, and your order is filled. Or you could call your broker and say, buy it for me, but I don't want to pay any more than 12. That's called a limit order. The next thing he asks is if you want it canceled at the end of the day, or when you cancel it. You say, when I cancel it. So he enters in GTC, or good till canceled, or you say you want it only for the day. That's a day order. Both GTC and day orders are limit orders. I'm giving the broker a specific limit. The floor broker runs around to where ABC is traded and says, I want 100 shares of ABC at 12. What's the market? They say 12 and a half. No, I have to have it at 12. They say 12 and a half. He leaves it with the specialist at 12. Now the specialist runs the books on that particular stock. That will go on the specialist books. If the specialist has some other orders on the books with some other firms at 12, your order will go on behind theirs, and the first trade that happens at 12 will be the first on the specialist books, then the second, then the third, then the fourth. This is called your level of priority. Now, what's the danger of a limit order? If the stock starts to go to 12 and an eighth, 12 and a quarter, 12 and a half, you'll miss out on buying your stock. If you want to buy the stock and you think there is a reason to buy it, normally a market order is the best way to enter an order. What you can do then, if you bought it at 12, you can enter an order to sell it at 16, and it will be on the specialist book, good till canceled. That's market orders, limit orders, and the third kind is a stop order. You bought the stock at 12, and you're afraid it might go down. So you can enter a stop order which says if the stock goes from 12 to 11, I want to get out. And that is a sell order that is triggered by the stock hitting a certain price. Now what will happen if the stock goes from 12 to 11, your order becomes a market order. Now the next trade might be 10 and a half, and that is what you would get. You would not necessarily be locked into the stop order, but you are triggered into a market order by having a stop order. And this is what the exchange actually looks like. The other type of market is called the over-the-counter market. OTC is a market made up of different brokerage firms. They take on a stock and say, I will make a market in this stock. They are called market makers. At the beginning of each day, they will issue what they are willing to buy 100 shares for and what they are willing to sell 100 shares for. That's put into what we call the pink sheets. Most brokerage firms will have the pink sheets of OTC stocks, what the different market makers or brokerage firms are willing to buy or sell 100 shares for. So you enter a stock to trade in the OTC market. It goes through the central processing to the actual trading room at that brokerage firm. They will access the different market makers to determine what the market is. And they will come back and say, well, the market is 12 to 13, which means someone is willing to buy at 12 and willing to sell at 13. Sometimes there is a pretty large spread in the over-the-counter stocks. Sometimes the spreads can get really large, so you are trading in a thinly traded stock. That's one of the dangers of the over-the-counter market, is that you have to make sure that there is enough market makers and enough liquidity in the market. For instance, if you buy a stock at 13 and immediately the bid is 12, then you're already down a whole point just to be able to get out. This stock really has to start moving. So that's the over-the-counter market. You'll often hear the NASDAQ, and that's the system between the different brokerage firms that you can access through the brokerage firm terminal using the ticker symbol. And we'll go over the ticker symbol in a little bit. So you have your listed exchanges and your OTC or NASDAQ. When you buy or sell a stock, it will have a 3-day settlement. That means when you buy a stock, you have 3 business days to pay for it. When you sell a stock, it will be 3 business days before you get your money. Commissions could range anywhere from 10% for a small trade of $500 or $600 all the way to 2 or 1% when you get into the $10,000 or $20,000 range. The smaller the amount of money, the larger the commission as a percentage of the trade. Or the smaller dollar amount of the stock, the larger the commission as a percentage of the stock. You have an example in the materials of a commission schedule. Now, you're going to pay the commission when you buy and when you sell. So if you're actively trading in small amounts of money, you could spend 5% in, 5% out, 5% in, 5% out. You're already into it for 20%. It's more difficult to trade in small stocks because of the spread, where you're buying at 13 and not able to get out but at 12. So you could see that the smaller the amount of money, the harder it is to actively trade stocks. Now, if you buy 100 shares, that's called a round lot. If you buy anything other than 100 shares, that's called an odd lot. If you buy 120 shares, the 100 shares would be the round lot, the 20 would be the odd lot. Those would probably be done in 2 different trades. Now, there's even a theory that says those who are buying odd lots are always wrong. The average person will always be wrong. So when you see a lot of odd lot activity buying, then that is the time to sell. Or when a lot of odd lots are selling, that's the time to buy, because the average person will always buy high and sell low and is never convinced that the stock will actually go up until it's already gone up. Let's take a look at how to read the paper. Here's an example of a newspaper. It's the New York Stock Exchange Composite Transactions. Look on the left-hand column at AT&T. Go down just a little bit and you'll see AT&T. Over to the left is the 52-week high and low. The high for AT&T for the last 52 weeks is 63.25. The low is 49.5. Then it says the stock, AT&T. The ticker symbol is T. We'll go over the ticker symbols in a little while. Then it comes to dividends. What does the dividend mean? That's $1.32 per share per year. Now, how often is that paid? It's paid quarterly, and the payments add up to $1.32 for the whole year. Okay, back to the stock. The yield from that dividend, if you took that $1.32 and divided it by the going price, is 2.4%. The PE ratio is 17. Let's stop right here and go through PE ratios. The PE ratio can often be thought of as a popularity index, the price over the earnings. Let's say that the price per share was $50 per share. The earnings of the company is $5 per share. That means that the price per share is 10 times that of the earnings. Each stock in each industry will have its own PE ratio. The earnings of a high-tech company might be more volatile but also have a greater potential of increase than the earnings of AT&T. So AT&T has a PE ratio of 17. Here's where the PE ratio comes in. This is called fundamental analysis. All stocks are not going to keep the same PE ratio, but during the year, they're going to have highs and lows. But over the course of time, most stocks and most industries manage to maintain a PE ratio. Even the Dow Jones and the S&P 500 index have their own PE ratio range. Now, ABC Company has an average 10 times PE ratio. The next year's earnings estimates are $6 a share. We're going to solve for next year's price of the stock. We're going to say X, which is next year's price per share, over $6, which is next year's earnings estimate, equals 10 times. So X equals $60 a share. 60 minus 50, 50 is what we paid for it, equals a $10 profit. $10 divided by $50 equals 20%. This is why the earnings estimates that come out by the major brokerage firms and major investment houses are so important. Now, most portfolio managers will say, I'm not going to buy a stock that I think will return me less than 20%. I'm not going to take the risk inherent in the stock if I don't feel like I can get at least 20%. She might do a PE ratio analysis and say, well, that looks pretty good. That's a 20% return. And then a large brokerage firm will come out and say, we have lowered the estimate of this year's particular stock from $6 to $5 for this year. And you can see a lot of selling come in because according to the fundamental analysis, it won't rise. Okay, back to our paper. Then you have the sales in hundreds, then you have the high for the day, the low for the day, and the close for the day, and the net change from the day before. If there is a split, or if there's an X dividend, it may have an S or an X next to it. This means something special has gone on with the stock. This will be in the footnotes. Now, what is a stock split? A split is a psychological ploy to keep the stock price down so that the average person can buy a round lot. When a stock gets up to $40 a share, that's $4,000 just to buy 100 shares. But when it is $20 a share, that's just $2,000, and the average person is happier with it. If you have 100 shares at $40 and they declare a 2-for-1 split, you then have 200 shares at $20. That's all a split is. Normally, the company will also take the opportunity to raise the dividend at the same time of the split. The ticker symbol is the symbol given to each stock where stocks are identified between brokerage firms. And if you've ever seen that screen that goes across a brokerage firm, that is called a ticker screen. In the financial districts, offices used to have ticker machines that fed out a steady stream of quotes on thin rolls of paper all day. This scrap paper was used as confetti for ticker tape parades. Now you'd have to throw a computer screen out the window. What is in the paper is an abbreviation, not the ticker symbol. You need to know the ticker symbol to call a brokerage firm for a quote. The broker types the symbol into the system and immediately has the bid and ask, the auction market, that spread in there. The bid and ask is what you need to know. So having the symbol helps the broker identify quickly the stock and get the quote you need. Also, if you're going to watch the ticker screen at the bottom of the TV or in a brokerage firm, you need to know the ticker symbol. Examples are Bell South is BLS, AT&T is T, and Exxon is XON.